So, what's the most important tool in trading? Not indicators, not strategy. What do you think it is? Bingo, you got it. Time. Now, we're going to put time and we're going to put money. We're going to put it as a tie. Now, time is really the most important, but if you have money, then you can allow yourself as much time as you need. So, what I mean by that? So, think about trading options. You have expiration dates, right? So, just say if you buy an option on, just say, June 1st, your expiration date, just say it's a week, June 7th, June 8th. Right. So, just say the price is at $10. Now, over the period of that week, it's fluctuate. By the end of the week, just say the price goes to $8. So just say you had a call option and you were banking on the price to go up, so above $10. Now, how it usually works is after that week pass and the price finished at $8, you took a loss. So the price went down $2. So just think about options. Just say you had 10 contracts. And you had a delta of, let's just say for conversation's sake, just say that's your delta. So that's like 0.50, like 50 cents, which is what options you times it by 100. So that 50 cent is like $50. Okay. So just say you got 10 contracts. So that's like $50. And so for each dollar that the stock move, that represent what options. Each dollar represents, this times 100 equals $100. So for each dollar the stock rises in this particular contract that you have, option contract with the delta 50. So for each dollar it rises, your contract, for each dollar you have 50 cents for each dollar. So if it goes up $1, you get $50. If it goes up $2, you get $100. So the opposite, If it goes down $1, you lose $50. If it goes down $2, you lose $100. So, an example we gave, if you got the option and it was at, the stock price was at $10, but over the course of that week, it went down to $8. So that's a minus $2, right? So that's down $2. And for each dollar, the option that we're using for the example, it was worth $50. So that means a negative $100, right? Now, just say that same contract. Hold up now. Let's finish the math. So a negative $100, right? I forgot, but it was 10 contracts, right? So that's really a negative 1,000, right? Now, just say the same contract, instead of having an expiration date for a week, you had it for, say, just say a month. So just say roughly 30 days, right? Or we can even just say 20 days if we're just counting the actual trading days. Now, if you have 5 days compared to 20 days, which one do you have more time for your option trade to actually work? So, the example we gave, price start off at 10, it fluctuated. So just say by the time that first week, it was at $8. It went down. Now, week 1. Okay. So week 1, it finished up at $8. So we're going to do it like this. Week 1 started at 10, ended at 8. Okay. Week 2, fluctuate, went up. Just say it ended at 12. Week 3, just say it ended at $15. Week 4, say it ended at $16. Now, you only having a week expiration time, and $8 is what it closed in, you was at a loss. Now, if you was able to have it for 4 weeks for the whole month, this $10 You know, you had drawdown to $8, then up to 12 the next week, then drawdown them up to 15 the third week. Then the fourth week was up to 16. So if you actually had the time, you gave yourself more time to be right. So, but the more time you have, the more money it costs. So you need more money to get more time, but time is the most important tool for trading. You can have a contract a year out, 2 years out. So you think that the contract that long would give you the chance to be right, enough time to be right? Of course. The market going to go up, it's going to come down. It's going to go up, it's going to come down. It's going to have big moves up, it's going to have big moves down. But eventually it'll go back up. And so if you didn't know any skills, how to use any indicator, anything like that, if you could just kind of look at the charts and just see the recent prices, where they was at, like the recent highs, the recent lows, the monthly highs and lows, the last 90-day high and lows, the year-to-date high and low, if you kind of could just see where price has been, far as the highs has been and the lowest has been, and if you get a decent pullback and the price come down a certain amount, significant amount, and then you say, okay, it came down to X number, but it's been up to these other numbers. So it's a good chance that it's going to go back up to those numbers. So you can get in and give yourself enough time. You give yourself 6 months. The contract that expires in 6 months, expiring in a year. You don't even have to really even know how to trade or what you're doing. You can just let time do the work. And so over a period of time, you know, it'll go there. So you could set your stop loss and then set your take profit. Or if you just wagering what you are okay with losing. So just say if you okay with losing a certain amount per trade, just wager that from the beginning. You know, if you have, just say if you spend just say $500 on an option, say you cool with losing 10%. So you say, bam, okay, cool. I'm cool with losing $50. So, and this just for example purposes. So just wager 50. Just go get a contract, and this just for number purposes. A contract with $50, and then matter of fact, don't even no you don't even have to do that. If you give yourself time, because I was just gonna say, if you was cool with wagering the 10%, so that would be $50. So just get a contract at $50, and then don't set a stop loss, and you'll just let time. With 6 months, within 6 months, I'm sure to hit your price. But you don't even have to do that, because you will be so out of the money with that. So just get whatever contract you wish with the delta you wish, because now to think about it, $50, you won't be getting a 0.50 delta. But just get the contract you want. And if you give yourself that much time, and like I said, if you seen where it pulled back, you let it pull back, and you notice there was previous areas, whether it was the previous day, the previous week, the previous month, the previous 3 months, if you see where they have been, the price has been, and you know that it pulled down from there, you know it's going to go back up. So all you need is time. You don't even need to know how to read any indicators or none of that. Just let it go. Just set your take profit, right? And so that's just a long version of pretty much time is your most valuable tool when trading. So we're gonna just put that at a tie with money, because you can't really get the best time, the best contract, the best long expiration dates unless you actually had a capital to do so. So I hope that helped. Hold up, matter of fact, let's do this. Let's do this as well. Let's do this. Okay. Let's see. Let's see. Okay, we at Coinbase. So Coinbase has been down a little bit, this week. So overnight, going up $3. Now, so the current price is at $339.75. Now, if we look at it over the last week, the highest it was like 401. So if we think about within a week, the past week, the highest was at 401. So it's at 339. So just round the numbers off, 340, and then on a 10th, it was at, just say, 400. So that's a $60 drop. And today's just the 16th. So within a week, a $60 drop. Now, let's go back a month. So it was at 320s, 40s, 20s, 13, and it went all the way up. And it got high as 401. Let's see, what is this? Come on. It's a month. Okay, but we know on the 10th it got high as 401. I'm not sure why you're on the 10th. It's going as high as 490. But anyway, we know it went to 401. So 3 months. In July it was up to 419. So basically we know September 343. $367 October. So we know there's some prior areas that the price was at. So with that being said, we can make an educated guess and say that at some point, we don't know when, but at some point for sure, it's going to revisit those areas. So all we need to do is just give ourselves time. So if you got the money, you can get the option with as much time as you need and just let the time do its course. You don't have to worry about no moving averages, none of that. Just let time. So this is another way we're going to look at it. All right. So we know over a week period of time, and it made a $45 move. And so with stocks, with options, you can make money in any direction, the price going up or down. Over a month, $17. 3 months, $52. Let's look at another stock. So within over the week, so the current price is 41, 241. And so over the week time, $2, just say a month, $81. 3 months, $85. Let's do SPY. Okay, over a week, almost $6.50 move. Over a month, $6. 3 months, $42. So we know they're making these type of moves. So just say 3 months on average, the stocks will make maybe a $40 move. Let's just say that on average. So just say you had an option contract for, just say, 6 months. Now, if we can assume that it's going to make a $40 move within 3 months, so, or just somewhere near the $40. So if we at the price of 666.37, at some point, even if we want to take a fraction of the price of the move, just say we don't want to say, okay, the full $42. Let's just say we cut a fraction of that. So I'm gonna get a call option or something for 3 months, and I'm only looking for a $15 move, or just say $20 move. And all you got to do is really just let the time go, take its course, because what we seeing is over a week, $3 move, $2.93. Just a $3 move. Over a month, $10 move. Over 3 months, $30 move. So basically, if you would have got a call option or bought stocks or whatever, even if you're just trading stocks and you bought it at the price that it was, then 3 months ago, if you would have did that, and then up until today, it would have went up $30, almost $31. So it's going up, $10 for the month. So they all going up. Look at 3 month, $47. So all you had to do, 1 month, $12. So it don't matter these pullbacks and it come down and it go up and come down and go up. The gradually over time, it still was trending up. And this is just what all the stocks want to do. They just want to go up. Let's do Cloudflare. Now, currently at 218. $2 move over the week, over the month, $4.30 move. What's the 3 month? $29. So we seeing the big moves is, looking like that 3 month with Netflix. $100 a week, 85 cents on a month, up 175. Watch the 3 month, $55 move. The year to date. So with January, February, March, April, May, June, July, August, September, October. So year to date, 10 months, it went up $310. So that's 10 months. So January, it was around $895. So just say you had it for 6 months. We're not even gonna say the whole 10 months. So January, let's say to July or June. So June, 1,200. Now, the reason it's only 300 year to date is because, just say the highest was right here, June 30th, $1,339. But it came down some to 1,170, then it went up a little bit, $1,243, and it came down some. But so like I said, we just said we had it for 6 months. So just say around here, June 10th, 1,200. So from $895 to $1,200, pretty much $300 just right there. So a $300 move. Now let's go back. What we say for the contract example we had, for each dollar move, we get $50. So and we had 10 contracts, right? So let's do the math. 50 cents times that 100 equals $50. Now, we had 10 contracts. That's $500. Now, so basically each dollar move, we get for each dollar the stock rise, we get $500. So from January, like we said, we had an option for 3 months. It would have had rose like $300. So we times this $500 times 300, 150,000. Now, all we needed was time. We didn't have to know about no indicators, none of that. We just needed time. So history shows that the price is going to continue to go up. Even if it comes down, eventually it's going to go up. So let's go look at just something that a lot of people trade. So let's say year to date. So in January, QQQ was around 524. Now, another thing I will add. So I'm giving an example about 6 months. That don't mean that you have to wait until 6 months. You can sell it whenever you choose. And so just say for instance, I'll give you an example why I'm saying this. So around January 2nd, it was like at 514 QQQ. Got up to like 539, then it went down 480, 460, 440. Now it's coming back up. So by the time early June, 527. So 518, 528 pretty much in 6 months. So that's just a $10 move. Now, year to date, that's a whole different story. So you're looking at $100 move on the stock price. But just for example, say we only had it for June. And so let's do this. 518, 6 month contract, but just say right here, February the 19th, it went to 539. Just say I'm gonna get rid of it there. You don't have to hold it to the 6 months. So 539 from 518. That's like a $20 move. Now, if we do the math, now remember, 500 is our number. Our delta was 50, which equates to 100 with $50 with options. Each dollar that the stock price move, then the option goes up $100. So for each dollar, that's the $100 for the option. So $50 for one contract. But if we got 10 of them, $500. So remember our $500. Now, we say that price move $20. So we times that by 20. So that's 10,000. So that's $10,000 just from January like the 3rd to January the 19th, the 18, 19. So in about 2 weeks, 2 weeks time, $10,000 made. Okay, so just say you was able to afford a contract for a year. So January, you say, that 518. Did you say 518? So right now we just use the current price, 604. So we'll just round it off. We'll just say we'll just say 515. Let's just say 515 to 605, or just say 600. We'll just say round it out. Just say 600. So 515 all the way to 600. That's $85. $85 move. Now we go back to do our math. 500 times 85. $42,500. So that's just 10 months from January to current. So let's just do another stock for one more example, so y'all can see. Let's do we could do Nvidia. Let's do Amazon. So now, even though you see this price has came down, okay, say in January, it's around 222, down to 218, got high as 242. Now, like I said, you don't have to keep it all, you can get out when you want, so you could have took profit here. So this is February 3rd, 242. From January 3rd to February 3rd, we're dealing with 24, 42. So that's $18 move. Now you got time, so bam, you got all this drawdown. Oh, it's drawdown. This is what a lot of people will start selling. But if you get yourself a time, you got a contract for a year, it's gonna go back up. It's going up, going up, going up. Now started at 224. Now it's pretty much lower, but give yourself time. So if you had it for a year, you still got it for almost 2 months. It's October 16 now, so you got about 2.5 months half a month would be in November. No, about a month and a half. Well, hold up, no, that's right, 2.5 months, because in about a half a month it'll be November. Then another whole month, uh, it'll be December. Then another month, it'll be January. All right, so 2.5 months. Um, okay, so by 2.5 months, I was sure it'd be up. But you could have made money right here. But Amazon been down bad. Okay, let's go do the video like I wanted to do. Now, $10 move down over the week, over the month, $5 move up over 3 months. $10 move, year to date, $45 move. Now you had we say a year, $47 move. So now, year to date, 136. So in June, 137. So in 6 months, it's about the same, area. Now if we go fast forward to current, it's 81. It may push up. So let's say 136 to current 181. So for number sakes, we'll just say 135 to 180. So that's $45 move. Do this last calculation. So what was that? A $45 move. So we got our 500 times 45 equals 22,000. So that's NVIDIA. So you just had it 10 months. And I mean, you had a contract, an option contract for a year, but it's currently 10 months. Went up to 181. Now it might go higher than that. So just say by the end of 2 months, it's at $200. So that'll be like a $64 move. So 500. Ooh. Yeah, $65. I said 64, but I meant 65. So times 65, 32,500. So, that's some people's salary. Some people make that a year. Now, and I mean hard labor. You made that in 10 months. And that's just one trade. One you trade at one time and you just say, I'm gonna see what it's gonna do at 6 months or 10 months. You just let it go up. So basically, this whole thing isn't about how the most you can make. It's just about an example of over time they always go up. And so as long as you got time, it shows that you can be profitable. So that's just the reason for the video, to show you examples. So later.